For so many of us, it's really the ultimate question. Financially, lifestyle-wise, should you rent or should you buy a home? It's this debate that just never goes away. But let's be honest, here in 2025, it feels, well, more complicated, maybe more loaded, perhaps even more out of reach than it ever has before. So we've really dug in. We took your questions. We poured over the sources you sent, everything from, official housing reports, economic analyses, right down some really candid chats happening on Reddit, all to try and figure out what's really going on with the housing market right now. Our mission today, it's simple: equip you with the key facts, the figures, and yeah, some surprising insights too. Cut through that noise so you can feel genuinely well-informed about making what is, let's face it, a huge decision.
That's exactly right. Because the 2025 housing market isn't just challenging. It's this kind of perfect storm of historically high prices, interest rates that are still pretty elevated, and also shifting priorities around lifestyle. The old rules, they just don't quite fit anymore.
Okay, so let's unpack this. What's the overall picture? If you had to paint one for the housing market as we're navigating 2025, it sounds like there's a lot of sort of opposing forces.
There absolutely is. I mean, the first thing that jumps out is just how much home prices have fundamentally shifted. Nationally, they're up, get this, 60% since just 2019.
60%, wow.
Yeah, and as of early 2025, they're still creeping up, almost 4% year over year. Just to give you a number, the median existing single-family home price, it hit $412,500 in 2024. Now, that's 5 times the median household income. Traditionally, affordable was seen as, 3 times income, so we're way, way past that.
5 times, that's a massive gap.
Right.
So, okay, with those kinds of prices, you'd think sales must have just cratered. What are the numbers actually showing? Are people still managing to buy, or are we seeing things really slow down?
Well, existing home sales definitely took a hit, a big one. They dropped to a 30-year low in 2024, just over 4 million sales.
30 years.
Yeah. And part of that is this lock-in effect, right? People have these great low mortgage rates from before. They don't want to sell, so fewer homes are listed. But here's where it gets interesting. New home sales. They actually increased last year by 3%.
Yeah.
And new construction now makes up the biggest slice of total home sales since way back in 2005. It's about 16% of the market.
16%. That's a really strong signal then. So, okay, existing homes are hard to come by, but builders are trying to pick up the slack. Are there enough new homes, though? And, what kind of homes are they building?
Well, inventory is recovering, which is good news. Yep. It was up about 20% in March 2025 and rising in almost all the big metro areas, 98 out of 100.
Okay.
But, and this is a big but, it's still way below where we were before the pandemic. So to kind of adapt, builders are doing a couple of things. New single-family homes are actually getting smaller. The median size dropped to around 2,150 square feet in 2024.
Smaller homes.
Yeah, and they're also, cutting prices sometimes or offering these mortgage rate buy-downs to help buyers actually qualify for the loan and make the sale happen. And then quickly, on the rental side, we saw this huge boom in new apartment buildings finishing up over 600,000 units in 2024. That's the most in nearly 40 years.
Wow.
Which definitely helps slow down rent growth for a bit. But that boom, it's ending now. So that kind of sets the stage for rents to possibly start picking up speed again.
All right, let's get into the nitty-gritty then. This is where it gets really interesting for anyone trying to figure out their budget. Let's talk upfront costs first. Renting versus buying. I imagine just getting in the door is a big hurdle.
Oh, absolutely.
It
It's
is.
huge. For renting, you're typically looking at a security deposit, maybe 1, maybe 2 months rent, plus your first month rent, and then application fees, maybe a few $100.
Right.
For buying. It's the down payment, of course. It can be as low as 3.5% for an FHA loan, but more often it's 5%, maybe even 20% for a conventional loan. Then you add closing costs, another 2 to 5% of the house price.
Oof.
Yeah, and inspection fees. We actually saw a Reddit user talking about this, said they saved up 10%, which is about $25,000 for a house in the $200,000 to $250K range. Just gives you a real sense of the cash you need on hand.
25 grand just to get started. Okay, so once you're past that initial hit, how do the monthly payments stack up? What's the data actually showing is cheaper right now, day to day?
Well, there was a bank rate study, pretty recent, February 2025, and it paints a really clear picture. The average monthly mortgage payment, and this includes property taxes and homeowners insurance, for a median-priced home in the U.S., $2,768.
Okay, and rent.
Average monthly rent, factoring in things like renter's insurance and inflation, comes out to about $2,000 a month.
So wait, that's over $750 difference.
It's a $768 a month difference, yeah, which works out to over $9,200 a year in savings on average for renters. Put another way, nationally, that average mortgage payment, It costs 38% more each month compared to the average rent.
38%. That's a staggering difference in just monthly cash flow. But I bet there are hidden costs too, right? Things homeowners are paying for that often get, overlooked in that simple monthly payment comparison.
You are absolutely right. That's a huge piece of the puzzle. While everyone focuses on the PITI principle, interest, taxes, insurance, our deep dive shows there's almost this invisible second mortgage for homeowners. It adds up to nearly $20,000 a year.
20,000 on top of the mortgage.
Yeah, it breaks down roughly like this.
Yeah.
About $7,300 for utilities, over $6,000 for maintenance, think HVAC, roof repairs, pest control, lawn care, appliances breaking.
Well, man, yeah.
And nearly $5,800 for renovations or updates, that Reddit user you mentioned. They specifically called out how these sudden big expenses can be a major, major downside. A trap, really, if you're not prepared. And let's not forget property taxes and home insurance premiums are also climbing. Home insurance costs jumped like 57% nationally between 2019 and 2024.
57%?
Yeah. Places like Miami, you could be paying over $11,000 a year just for insurance. And property taxes, they're up to about 12% between 2021 and 2023, averaging around $4,400 a year nationally.
Wow. Okay, $20,000 a year in those other costs? That's almost like another car payment or more. No wonder people feel squeezed. What about renters, though? Are there hidden costs for them, too, beyond just the advertised rent?
Yes, there are, although typically not quite as severe or unpredictable as homeownership. Renters still have security deposits, sometimes move-in fees. Monthly utilities usually run $100, $200. Renter's insurance is pretty cheap, maybe $23 a month. But then you might have parking fees, pet deposits, or even monthly pet rent if you have pets. And of course, the big one is the uncertainty, the risk that your rent goes up significantly when your lease renews. That's always hanging over you.
Right, that lack of control. So, given all these costs, upfront, monthly, hidden, the question everyone wants answered is, when does buying actually become the better financial move? Is there a point where it flips?
There generally is, yeah. The key concept here is often called the 5-year break-even rule. What the research tends to show is that because of those really high upfront buying costs, the down payment, the closing costs renting is usually more economical for the first few years.
Okay.
But if you plan to stay in the home for longer than about 5 years, that's typically when the financial advantage starts to shift towards ownership. The equity buildup and potential appreciation start to outweigh those initial costs. And here are 2 quick rules of thumb you can use, kind of back-of-the-envelope calculations for your own area. First, the price-to-rent ratio.
Okay.
You just divide the median home price in your city or neighborhood by the median yearly rent. If that ratio is somewhere between 1 and 15, buying probably looks better financially. If it's 16 to 20, renting might make more sense. And if it's 21 or higher, renting is pretty clearly favored.
Got it. Price-to-rent ratio is the second one.
And the second one is called the 5% rule. It's a bit different. You take the home's value, multiply it by 5%. That's supposed to cover approximate costs like property taxes, maintenance, and the cost of capital, and then divide that by 12 to get a monthly figure. If you can rent a similar place for less than that monthly figure, then renting makes more financial sense according to this rule. So, for example, a $250,000 home, that 5% rule figure comes out to about $1,042 a month. If you can rent for less than that, renting wins by this metric.
Okay, those are handy rules of thumb. It's clear the numbers are complex, maybe even a bit counterintuitive right now, but this whole decision isn't purely about dollars and cents, is it? What about the lifestyle side of things? That feels just as important.
Oh, absolutely. You nailed it. The finances are critical, but lifestyle is arguably just as, if not more, important for many people. Renting, for instance, offers this amazing flexibility and mobility. That's super attractive if your career path isn't totally certain or if you think you might want to relocate fairly often. We saw one source mention James, a freelance consultant who just loved being able to pick up and move easily and, crucially, not having to deal with home maintenance, headaches, or costs.
Yeah, I can see the appeal there.
Definitely. But then homeownership, it offers something else. It provides this deep sense of stability, right? A feeling of belonging to a community. And the freedom to really make a space your own, personalize it. There was this quote from a Reddit user that really captured it pretty vividly. They said, "It's your outhouse. Technically, sure, the bank own the equity, but you own the autonomy. To wake up in your bed and look out on your yard and say, 'This is mine,' is a feeling that keeps on giving."
Wow. That's powerful, that autonomy.
Exactly. It includes things like privacy, maybe having your own yard, and importantly, not having to wait on a landlord to fix things. You're in control.
That feeling of control and ownership,
Mm-hmm.
it often goes hand in hand with the idea of building wealth, right? That's usually a huge selling point for buying. How does that aspect look in today's market with these high prices?
It's still a major factor. What's really interesting is how your mortgage payment itself helps you build wealth. Part of each payment goes towards the principal, reducing your loan balance. That's building equity, essentially. It's a form of forced savings.
Forced saving.
Yeah. So on that $250,000 home example, just the principal payments alone could build up over $63,000 in equity over 10 years. And then if you factor in typical property appreciation, let's say a conservative 3% annually, you could be looking at nearly $150,000 in combined equity over a decade.
Okay, that equity growth definitely sounds compelling, but isn't there a counter argument? Like, what if you took that big down payment you didn't spend on a house and invested it somewhere else, like the stock market? Could that potentially do just as well, or maybe even better, without all the headaches and hidden costs of owning?
That's an excellent point, and it gets right to the heart of opportunity cost. It's a crucial calculation. If you don't buy, you absolutely could invest that down payment money. Historically, the stock market averages around a 10% annual return over the long run. And even things like private equity funds, though maybe less accessible to everyone, have historically done even better, averaging over 13% annually over 25 years. So yes, putting tens of thousands or even hundreds of thousands into a down payment means you're not putting that money elsewhere. That's the trade-off.
Right, the opportunity cost.
Exactly. And speaking of the financial side, we should also touch on taxes. Homeowners can get some tax breaks. You can usually deduct mortgage interest up to a certain loan amount, currently $750,000. And you can deduct property taxes, but that's capped at $10,000 per household per year federally. That's the SALT cap state and local taxes.
But you have to itemize deductions for that, right? Which fewer people do now.
Precisely. You only benefit if your itemized deductions exceed the standard deduction. Renters, on the other hand, don't get federal tax deductions for their housing costs. Although some states, like Minnesota and Maryland, do offer specific tax credits for renters.
Okay. So zooming out again, if we try to synthesize all these different pieces, the costs, the lifestyle, the investment potential, the taxes, what does it mean for the market overall in 2025? And how much does where you live change the equation?
Well, looking ahead, most experts think mortgage rates will probably ease down, but only gradually. Maybe landing somewhere between 6.5% and 6.8% by the end of 2025. So still relatively high, but a little bit of relief perhaps.
Okay, slight relief.
Home prices, the expectation is for more modest increases, maybe somewhere in the range of just under 1% up to maybe 4.4% growth. So slower appreciation than we've seen. The rental market is also projected to see slower but still steady growth, maybe 1.3% nationally. Though, like I said, with fewer new apartments coming online, we could see rents accelerate a bit more in some places.
Right. But location is key, you're saying.
Location is huge GE, probably the single biggest variable. Overall, homeownership is actually still considered more affordable than renting in nearly 60% of U.S. counties, believe it or not.
Really? Even with those numbers?
Yeah, but it depends heavily on where. The Midwest and the South offer the best shots at affordable homeownership. Buying makes more financial sense in about 80% of Midwest counties and 60% of Southern counties. The West Coast, though, totally different story. Renting is the better financial bet in a whopping 80% of counties out west.
That's a stark contrast.
It really is. And you see it in specific cities, too. Metros like Detroit, Philadelphia, Cleveland. They have some of the smallest gaps between the cost of buying and renting, maybe only 13% difference. So buying becomes a bit more justifiable there, potentially. But then you look at the big tech hubs, San Francisco, San Jose, Seattle. The gap is enormous. Buying can cost anywhere from 119% to 190% more than renting per month. Renting is strongly favored there, at least in the short term.
Wow, 190% more.
Yeah. And one more trend, the donut effect is still very much a thing. Suburbs often hit that sweet spot, maybe slightly lower cost than the downtown core, but still decent access to amenities. And rural areas, they've seen an 80% jump in mortgage applications since the pandemic started, thanks to the appeal of remote work and potentially lower prices.
Okay, so location really is everything here. Given all these factors, the high prices, the rates, the location differences, what are the absolute biggest hurdles for someone trying to buy their first home right now? It sounds like an uphill battle.
It is an incredibly steep climb for many. The income needed just to afford the payments on a median-priced home is now around $126,700 a year. That alone prices out millions of renters right off the bat.
Yeah.
And then there's the down payment hurdle we talked about. Even a minimum 3.5% down payment plus closing costs On that median home in 2024, you needed about $26,800 in cash up front. If you wanted to put down 20% to avoid mortgage insurance, you needed $95,000.
$95,000.
Exactly.
Yeah.
So it's really not surprising that we're seeing first-time buyers are, on average, older than they used to be. They tend to be more affluent, and they're increasingly relying on financial gifts or loans from family members to make it happen. And what's particularly striking and, frankly, a bit concerning is that the overall homeownership rate actually fell in 2024. It was the first time that happened in 8 years. It dropped to 65.6%. And the biggest drop was among younger people, those under 35. It really highlights that these deep-seated disparities, especially the racial gaps in homeownership, aren't just persisting. In some ways, they might be getting wider.
That's sobering. So beyond just affording the house, what about those unexpected problems that can pop up after you buy? The headaches you don't really think about until you're suddenly dealing with a leaky roof or a broken furnace.
Those are incredibly real and can be financially devastating if you're not prepared. Our sources showed that millennials, in particular, who maybe skipped a home inspection to win a bidding war, often face huge financial risks later. The Bankrate poll found that a shocking 64% of millennial homeowners had regrets about their purchase decision. And 77%, more than three-quarters, had unexpected repairs pop up within the first year of owning.
77%? What kind of repairs?
The common culprits are things like roof defects, problems with the electrical system, plumbing failures, stuff that can cost thousands or even tens of thousands to fix, which is why that home inspection, even though it costs a few $100s up front, can save you so much money and heartache down the road. It lets you negotiate repairs with the seller or even walk away if the problems are too big.
That is a stark reminder. Buying the house is just the beginning of the financial commitment. And it really sounds like these individual struggles, whether it's affording a home or dealing with repairs, are symptoms of a much bigger systemic issue, right? A broader housing crisis.
That's exactly right. These individual stories are absolutely reflections of a wider societal problem. The number of homeowners who are cost-burdened, meaning they spend more than 30% of their income on housing costs, rose to over 20 million in 2023. And for renters, it's even worse. It hit a record high. 22.6 million renters are cost-burdened. That's half of all renters in the country. And within that group, 12.1 million are severely burdened, spending over half their income just on rent and utilities.
Half their income? That's just unsustainable.
It is, and tragically, we're seeing the consequences. Homelessness also reached a record high in January 2024, nearly 772,000 people. That's a devastating 33% increase just since 2020.
That's heartbreaking. So what's happening on the policy front? Is there enough support to address this crisis?
Well, that's part of the problem. Federal housing support, paradoxically, seems to be lessening, even as the need grows more urgent. Key programs like housing choice vouchers, which help low-income families afford rent, and public housing are significantly underfunded relative to the need. Now, we are seeing innovation at the state and local level. Many cities and states are experimenting with zoning reforms, things like allowing accessory dwelling units, ADUs, backyard cottages or basement apartments, or permitting smaller multifamily buildings in areas previously zoned only for single-family homes. They're also trying new financing tools.
Well, okay, so some local efforts.
Yes, but federal funding is often crucial to making those local efforts work at scale. And trying to build enough new affordable housing faces this perfect storm of challenges. High interest rates are the biggest barrier. According to builders, 91% cited that. Then you have rising inflation affecting material costs, soaring land prices, complex regulations and permitting processes, a persistent shortage of skilled construction workers, and even things like tariffs on building materials, which can add tens of thousands to the cost of a new home. It's a really tough environment to build affordably right now.
Wow. It really paints a picture of a complex, challenging landscape from top to bottom. So after all this, what does it really mean for you, the listener, trying to make this decision in 2025? It seems clearer than ever that the choice to rent or buy is deeply personal. It hinges on your specific financial picture, your lifestyle needs and wants, and your goals for the future. There's just no single right answer, is there? And as we've seen, depending on where you live, how long you plan to stay, the smarter choice, purely financially, can flip completely. So maybe remember that 5-year break-even idea. Really try to factor in all the costs, not just the mortgage, and think hard about what flexibility versus stability truly means for your life right now.
Exactly. And perhaps the final thought to leave you with is this. In a world where the traditional lines between renting and owning seem to be blurring, with costs and market dynamics constantly shifting, how will you define what home really means? Not just as a place to live, but for your financial well-being and, maybe most importantly, your peace of mind.